Hello everyone and welcome to another one of my investing videos where I try to simplify aspects of the markets and how they work. I would like to remind you that I am not a financial advisor. Anything I say here is for education and entertainment purposes only. You can and will lose money if you don't do your own research. In this video, I will try to explain the basics of a covered call and how it is used. If you're not familiar with options and the basic principles behind them, I suggest you watch my options basic video. Holding shares of a company is great. Over time, they can have the potential to generate substantial returns, but a company's share price does not go up in a straight line. It will go up and down over time. A covered call is a strategy people use to generate extra income during times when the share price is in a downtrend, sideways distribution, or accumulation phase. If used and executed properly, writing covered calls is a great way to generate extra income. And covered calls are considered to be bearish. There are two key aspects to consider when writing covered calls. Number one, the seller of the contract must own 100 shares of the underlying. Number two is the seller must be willing to accept the fact that the shares can be taken away from them at any time if the contract is in the money. When writing the covered call, you are essentially selling a contract stating that you're willing to sell 100 shares of the underlying at an agreed price if the share price of the underlying reaches that price on or before the contract expires. If the share price is out of the money, essentially trading below the strike price, the buyer of the contract cannot exercise the contract and buy the 100 shares from you. If the share price reaches the strike price, it is at the money and the buyer has the right to exercise their contract. The same is true if the share price is in the money and trading above the strike price. Let's explore several ways buyers and sellers can be affected when selling covered calls. Suppose a company's share price is trading between $9 and $11 and a person decides to sell a covered call with the $12 strike price that expires in May and the price for the contract is $10. Now the stock will continue to trade until expiration, but there are three possible outcomes that can occur. The outcomes are it expires in the money, at the money, or out of the money. In scenario 1, the share price is at $13 at expiration, the buyer paid $10 for the contract and the seller collected $10 for selling the covered call. It is in the money. The buyer has two options. The buyer can sell the contract for its intrinsic value, or because the option is in the money, the buyer has the right to exercise the contract and buy 100 shares of the underlying stock at $10 per share from the seller, leaving the seller with only a gain of $10 minus 100 shares. In scenario 2, the share price is at $12 at expiration, the buyer paid $10 for the contract and the seller collected $10 for selling the contract. It is at the money and the buyer can try to sell the contract, or because the option is technically in the money, the buyer has the right to exercise the contract and buy 100 shares of the underlying stock at $12 per share from the seller, leaving the seller with only a gain of $10 minus 100 shares for this transaction. In scenario 3, the share price is at $11 at expiration. The buyer paid $10 for the contract. The seller collected $10 for selling the contract. It is out of the money. The buyer has a total loss of $10 and the seller would have made $10 from this transaction and they still get to keep their 100 shares. Some of the pros of a covered call are that it provides the ability to generate income and it gives some downside protection. And it can also lower your cost basis. For example, this is a profit loss chart for stock of a company. Here, let's suppose you bought 100 shares at $8 per share. If price goes above $8, your position is profitable, and if price goes below $8, your position is at a loss. If you were to sell a covered call that gave you a $1.50 credit per share, you would effectively lower your cost per share to $6.50. But this brings us to a con. By selling covered calls, you're essentially capping your profit. If you sold your covered call at the $8 strike price and the share price goes above $8, you could be forced to give up your shares at $8 per share, essentially capping your profit at $8 per share. Another con is that once you've sold a covered call against your shares, it will be a little harder to get out of that position. Ideally, you want to sell covered calls during certain points in time, like an extended move up in price. For example, after an extended move up with no news or catalyst, the share price of a company will usually pull back or go back down. After an earnings call, a company will give future guidance and you can get a good idea of the general direction of where the share price will go. Sometimes it will rally, other times it will flush, but waiting till after the earnings call, you can better position yourself so you don't get caught in the wrong end of the move. High implied volatility, or IV, can generate large premiums. Here you can see AT&T on the left and Peloton on the right. They are both trading around the same price, but you can see that Peloton has a higher IV, and as a result, it has a higher premium for the first strike that's out of the money. IV rank and percentile are also important. Again, here we have AT&T on the left and Peloton on the right, and their current IV rank and percentile. The higher the rank and percentile are, the better the odds of collecting a larger premium relative to its past performance. It's also important to keep in mind price action and other aspects of the market and not just trade based solely on IV. For example, here we can see Microsoft shares failed to break past this trend line. This could have been a good time to sell a covered call. Another time to sell could have been once the price broke below the support trend line and price got rejected on the retouch. A large portion of traders believe that as a general rule, you can get a better balance of risk to reward by selling a covered call with a delta of 0.3 or less, and if it has about 35 to 45 days till expiration. Times to avoid selling covered calls include right before earnings. Because as I mentioned earlier, earnings can have the share price go either up or down fast, and trying to collect premium before earnings can either be very profitable or leave you in a position where you lose your shares. And another is the ex-dividend date. Because just like earnings, the days leading up to the ex-dividend date can be volatile, and if the premium paid for the contract is less than the amount of the dividend, you can have your shares taken away from you if the contract goes in the money, especially if the buyer believes the dividend payout is better than the cost of the contract. Open interest and volume are very important. They provide liquidity and relative ease when trying to close a position. I like to trade options with a minimum volume of 500 and an open interest of 1,000. It's also important to know if you are opening or closing a contract. When you're writing a covered call, you're selling a contract and you're selling to open, giving you a credit. If you want to close the position, you're buying to close, resulting in a debit. You also want to avoid selling covered calls with extremely low premium compared to your share price position. If you are familiar with options or saw my options tutorial, you know that an option contract represents 100 shares. So if you own 100 shares of a company that is trading at $25 per share, your position is worth $2,500. If you sell a covered call for $15, you're selling a call that covers 0.6% of your position. But if you sell a covered call for $50, you can generate 2% of your position. You also want to sell above your cost basis. If you remember the profit loss graph I showed earlier, you can see that if you sold a covered call at the $6 strike price for $1.50 per share, your cost basis is still $6.50. But if at expiration the share price is above $6, you could be obligated to sell your shares at $6 per share. Given that your cost basis is $6.50 per share, you will be left with a net loss of 50 cents per share or $50 because you had to sell 100 shares at $6 each. If you found this information helpful and would like to see more videos like this or get notified when I release new videos, click the like, subscribe, and notification buttons. Leave a comment below if you would like to see a video on a specific topic. Thank you for watching and have a great trading week.